the management of Mars Financials, and Kamlesh Gandhi, the CMD of Mars Financial Services, is joining us. Mr. Gandhi, good morning and thanks so much for joining us. Give us a sense of what you are making on ground for the NBFC sector. Help us understand if there is any reduction in stress or is it still building up, and give us a ground check of how the NBFC sector is reeling right now and what's your outlook.
Good morning. So as far as the ground reality is concerned, it will differ from NBFC to NBFC. It depends upon how they have dispensed credit over a period of time, and that will result in the quality of the assets. But overall, we see the stress to be coming down gradually, but it will still take a quarter or two for the things to normalize. As far as we are concerned, if you can see from our results that we have been in a position to maintain the quality of the assets as we have done over the last 3 decades. And that is the result of extending credit where it is due. And we will continue to pursue this objective.
Good morning, Mr. Gandhi. This is Shrishti also joining in, but given your presence, you have quite a presence in Tamil Nadu. What do we understand that due to the draft lending bill in the state, more stress is building up and the small borrowers are delaying the repayment. Can you tell us the situation and how much as a percentage of your book will be impacted because of this?
So I would like to make a correction here. We don't have any significant book in Tamil Nadu. We have substantial book on the western side of the country, that is in 4 states of Gujarat, Maharashtra, MP, and Chhattisgarh, and in the north, that is Rajasthan and New Delhi region, and a part of the business come from south. So Tamil Nadu must not be contributing very significantly or not that in a cognizable way at all. So the question of that affecting our book does not arise. Secondly, this is a draft bill from the industry level and from the various industry bodies. The representations have been made that we are already a regulated entity and your regulations can cause more problems and it has more problems than offering solutions to the borrower. And we hope that something useful will come out in the final regulations, which will not hamper the regulated entities to operate in that state and extend the loans to the financially excluded.
Okay, so that's the take, and let's also understand what to expect on your asset quality front, given the situation that we're seeing a slight sluggishness coming in across the board for NBFCs. Should we expect NPAs to increase in the coming quarters? Could you give us any sense on your asset quality going ahead?
So we always maintain that we'll have a range-bound asset quality anywhere between 1.5 to 2% in our net stage 3 assets, and around from 2 to 2.5% approximately in our gross stage 3 assets. And we continue to maintain that guidance even for this quarter, given, as I shared with you earlier, given our victim of extending credit where it is due.
So the other thing I also wanted to understand was because, you've always said that FMCG and textile are the sectors where your company has slowed down its funding. Tell us a little bit about where exactly is the stress and when is it that you actually see the stress lifting off? And are there any other geographies where stress is visible more when it comes to these segments?
See, as far as FMCG and textile is concerned, we are still watchful. We are watchful from the fact that given the data analysis on the loans, what we already extended, we are yet to get that confidence to increase our disbursement to this sector. But as we know that every sector goes through certain cycles, and we are hopeful that within a quarter or two, this sector should stabilize, and we should see our disbursement back to normal in these 2 sectors also.
And also, Mr. Gandhi, how much rate cut is the company expecting in the coming quarters? How much will be the impact on the cost of funds? And where will the margins move from here on? Give us some sense there.
See, rate cuts on the repo front has already started kicking in, and we are just waiting for the same to be translated into rate cuts for the borrowers like us who borrows from the banks. We borrow mainly on the MCLR linked rates. So there will be MCLR. When there will be reduction in MCLR, we'll get the benefit. So we still see the transmission to happen 1 or 2 quarters down the line, depending upon the rate cuts from time to time. On the margins front, we see the NIMs anywhere between 6.75 to 7.25%. Last year, we could maintain the NIMs at around 7%.
Okay, Mr. Gandhi, I also want to get your view on these unseasonal rains that we've seen. We've had a slightly early monsoon season this time. Are you seeing any impact on collections or repayments, especially in the rural areas?
Not really,
Okay.
because as far as we are concerned, we have a banking-based collections. So majority of our collections happens through NSCH or eNSCH. So we don't have to contact borrower every time the installment is due. And for other players also, I don't see much impact. Maybe the regional players or in a particular region where it has rained heavily might have faced impact temporarily, but don't see much lasting impact there.
Okay, Mr. Gandhi, thank you so much for joining us. On that note, we'll let you go. Thanks once again for highlighting what you are expecting from the NBFC space, where you see this space headed, and what's the outlook for the company going ahead. On that note, viewers, time now to slip into a very short break, and we'll be right back with more on the other side.